Welcome to this, the fourth in our series of videos on the new exposure draft, Revenue from Contracts with Customers. In our previous videos, we introduced the 5 steps in the proposed revenue recognition model. Let's just look at a reminder of the 5-step approach. In this fourth video, we will take a more detailed look at the last step, step 5 on the right-hand side, and also other application issues for technology companies. Let's take a look at step 5, how to recognise revenue as each performance obligation is satisfied. A company would recognise revenue when or as it satisfies a performance obligation by transferring a promised good or service to a customer. And this is when the customer obtains control of that good or service. A performance obligation may be satisfied at a point in time, typically for promises to transfer goods to a customer, or over time, typically for promises to transfer services to a customer. Now, there are specific criteria which an entity is required to assess at contract inception in order to recognise revenue over time. For revenue to be recognised over time, either the performance creates or enhances an asset that the customer controls, for example, on-site improvements to customers' IT systems, or performance does not create an asset with alternative use to the entity, and at least one of the following conditions is met. Either the customer receives and consumes benefits as the entity performs, so perhaps maintenance or support, or the task would not need to be reperformed, or the entity has a right to payment for performance to date and expects to fulfil the contract. For example, a technology company develops customized software, expects to complete it, and is entitled to payment for progress to date. Now, for performance obligations satisfied over time, a company would select an appropriate measure of progress to determine how much revenue should be recognised as the performance obligation is satisfied. The proposals would limit the cumulative amount of revenue a company recognises to date to the amount to which the company is reasonably assured to be entitled to. Now let's consider some specific application issues. Firstly, how to account for licences. A licence provided by a technology company to a customer will give rise to a performance obligation that the technology company satisfies at a point in time when the customer attains control of the licence. Now, for US GAAP reporters, there is a significant change for time-based licences, which under current guidance may be recognised over the life of the licence. Okay, how to account for royalty-based fees. If the licence fee is variable, then the cumulative amount of revenue recognised to date will be limited to the amount to which the company is reasonably assured to be entitled to. Additionally, the 2011 ED states that if a company licenses intellectual property and receives a sales-based royalty, then the company would not be reasonably assured to be entitled to the additional amount of consideration until the uncertainty is resolved. So, for example, when a customer's subsequent sales occur. Okay, so what about how to account for costs to fulfil a contract? Now, under the 2011 exposure draft, a company would first consider whether the costs of fulfilling a contract are in the scope of another IFRS. If this is the case, then the company would apply the guidance in that other IFRS. The ED also proposes amending IS2 inventories to scope out the costs of a service provider. If the costs of fulfilling a contract are not within the scope of other IFRS, then a company would capitalise the costs if they firstly relate directly to a contract or a specified anticipated contract, they generate or enhance resources of the company that are used to fulfil the performance obligations under the contract, and they are expected to be recovered. Otherwise, the company would expense the costs as they're incurred. Now, how would a company account for the incremental costs of obtaining a customer contract? The 2011 ED proposes that companies capitalise the incremental costs of obtaining a contract if they are expected to be recovered, unless the duration of the contract is 1 year or less. Now, incremental costs, for clarity, are those that will not have been incurred if the contract had not been obtained. The qualifying costs of obtaining a contract will be recognised as an asset, amortised over the expected period of benefit, and regularly tested for impairment. Now, at present, there is diversity in the technology sector in relation to the accounting for costs of acquiring a customer or a contract. Some companies capitalise such costs, and some expense them as incurred. Those technology companies that currently expense all subscriber acquisition costs may meet the criteria to capitalise and amortise the incremental costs of obtaining a contract. What about how to determine whether a performance obligation is onerous? Well, the 2011 exposure draft retained the proposal to apply the onerous test at a performance obligation level rather than a contract level. However, recent deliberations indicate that the boards have tentatively agreed to retain the existing guidance on accounting for onerous contracts. That's the end of this video looking at the new exposure draft, revenue from contracts with customers. Thank you for watching.